I want to get to Brian Cheung. He's standing by. He was inside the lockup down in D.C. Brian.
Hold rate steady in the current range of 1.5 to 1.75. Little really changing in the policy statement. Two major things were different relative to the December meeting. So they described household spending as rising at a moderate pace relative to the December language describing household spending as strong. And then they also changed semantically how they describe policy with the context of inflation. They did say that monetary policy will support inflation, quote, returning to its 2% target, as opposed to the word near in December. Wouldn't read too much into this, as we did note from the December FOMC minutes that the policymakers had described a little bit of unsteadiness regarding the word near that it had been using for a long amount of time. They basically said this was a semantic change to show that policymakers would not be tolerating any sort of inflation that would be below its 2% target, and that they would want to see inflation returning to its 2% target. But again, wouldn't necessarily mean that the Federal Reserve policymakers currently see inflation rising to 2%. There is a multiplicity of viewpoints on that, depending on which Fed policymaker you're asking. And then the other bit that you talked about is really the technical change to the interest that it pays on reserves and excess reserves. They did notch it up by 5 basis points to 1.6. Previously, it was 1.55%. That had been the effective rate that the Federal Reserve was paying banks to leave money parked at the central bank overnight since the Fed had basically put its new target range of 1.5 and 1.75% in place in the October 30 meeting. So these are the major changes. Obviously, with no move on rates, the attention does shift to the balance sheet, as was just being discussed, and then also whether or not any sort of new geopolitical risk with the coronavirus, for example, or the flare-up in the Middle East pictures into the Fed's view on monetary policy. Those are things that could be addressed in Fed Chairman Jerome Powell's press conference, which will start in about 25 minutes down here in D.C. But again, the big headlines: unanimous decision, Fed holding rates steady in the first meeting of 2020.
Brian, help us understand a little bit more clearly what this 5 basis point increase in the the interest paid on excessive reserves means to the average consumer. I realize the banks are being paid this money, but is it the kind of move that would help them perhaps free up money to lend to us, or is it the kind of move that goes the other direction?
Well, it should be a relatively marginal change. Keep in mind that when the Federal Reserve makes moves on its interest rates, it's really aspirational. It's the Fed saying it would like to get the effective federal funds rate, the effective short-term interest rates in X range, which for right now is 1.5 to 1.75%. So the question really is whether or not the banks, because they're being paid 5 more basis points now, will be transmitting that onto consumers. You might have some that would say yes. You might have some that would say no. Regardless, 5 basis points is still a relatively small change, but the real point of this is to get the effective market federal fund or interest rate closer to the middle of its target, somewhere between 1.5 and 1.75%. Somewhere in the middle would be around 1.6, 1.62, 1.63. So hopefully this nudge up would do that. Keep in mind, this is actually a technical change that the Federal Reserve has done very recently. In the May FOMC last year, it actually did a technical adjustment to the interest that it paid on reserves in the other direction. It actually revised down the interest that it paid from 2.4 to 2.35%. At the time, the target range was between 2.25 and 2.5%. So they did make that change. So this is something that the Federal Reserve has done in the past, not necessarily unprecedented, but again, just trying to get it comfortably within range as the Federal Reserve continues to try to wrangle the interest rates following the repo flare-up episode that we saw in September of last year.
All right, Brian Cheung, thank you.